What is margin trading? Buying on margin sounds both exciting and risky. A bit like living on the edge. But I guess that's definitely not how you'd like to describe your investment style. Still, a lot of investors trade on margin every day and are quite happy with the results. So what if we do a bit of research and find out if margin trading is a good choice or a dicey approach? Basics of margin trading. What's a margin in an investor's vocabulary? It's borrowed money you use to buy securities. Or, in other words, it's a loan you take from your broker. Why would someone go into debt for investment purposes? After all, it's meant to bring you money, not to take it from you. Well, you might want to borrow some funds to buy more stocks than you would do with your own cash. This can allow you to receive more profit. The whole concept is called leverage and is widely used in the stock market. Let's see how this works with an example. Imagine you have $2,000 to invest. You can open a brokerage cash account, fund it, and buy whatever you like, let's say some stocks. If the stocks you've chosen go up by 5%, you'll get $100 extra. You earn the money and all the investments you have on this account, and you can sell your investments at any time. Things are a bit different if you open a margin account. First of all, here you have a minimum margin to deposit, which is usually no less than $2,000. Depending on the local regulations, you can then borrow from 50% of the whole investment sum, US and United Kingdom, up to 70%, Canada. Your investment possibilities are on the one hand more limited because each brokerage firm defines which securities are marginable. To protect themselves, brokers usually exclude high-risk stocks and funds. On the other hand, you get access to some specific securities and strategies such as futures, advanced options trades, or short selling. But let's assume you've bought the same stocks as with your cash account. However, this time you've spent not only your $2,000 but also another $2,000 borrowed from your broker. In case stocks go up by the same 5%, you double your profit and get $200 extra. Don't forget to subtract your broker's interest though. Still, that's not all the differences between the two accounts. As brokers, just like banks, want to have something as collateral, your account can't be empty. A certain amount of equity, known as the maintenance margin, is required to be on the account at all times. How much? The minimum is 25% of the security's total value, however, most brokers will insist on 30 or even 40%. That means with a total of $4,000 in stocks, you'll have to keep on your margin account about $1,200. That won't be a problem as long as your stocks are staying still or rising, as you've already deposited 50% of the investment. But if the value of the stocks falls down, there could be troubles. Imagine that the stock's value went down by 25% from $4,000 to $3,000. You still owe $2,000 to the broker, so there is only $1,000 left. In this case, you get a margin call. A margin call is a warning from your broker that the equity balance on your account can no longer satisfy margin requirements. This situation can be resolved in two ways. The preferable one is when you add funds to your account by depositing cash or transferring securities. This should be done quickly, however, you typically have a few days to replenish your margin account. If you fail to do so, then the broker will start to close some positions in your portfolio without even notifying you. In the worst-case scenario, you can lose all of your stocks and still own $2,000 to your broker. Is there a way to prevent such a disaster? Sure, there are a number of precautions we recommend you take so you can stay on the safe side of trading on margin. Use more than 50% of your own funds while trading. Limit your margin purchases to short periods of time to avoid unexpected price drops. Constantly monitor your investments and loans. Place stop orders above the margin maintenance requirement to avert major losses. Be ready for a possibility of a margin call. Think about where to find extra money to deposit on your account or which part of your portfolio to sell. And never ever ignore a margin call. Keep in mind that here we've discussed how margin trading works for traditional investments. Forex traders or day traders have to deal with special regulations. Still, whenever we talk about margin trading and leverage in general, it's very important to understand one basic rule. You can gain a lot, but you can lose even more. More than you've invested in the first place. So if you are a newbie to the stock market, don't rush to open a margin account. Get yourself comfortable with all the possibilities, chances, and instruments exchanges give you. Be mindful of risks. And when you are ready to go to the next level, welcome to the world of margin trading. Yeah, baby. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about the margin trading in the comments below. Thanks for watching, and don't forget to subscribe so you don't miss any of our new videos.